You've probably heard the phrase, let your money work for you. But here's what that phrase leaves out. The first few years of investing can feel like nothing is happening. Your balance barely moves. The math is running, but you can't see it yet. And that gap between what compounding promises and what your account actually shows is exactly where most people quietly give up. Charlie Munger said something that cuts right to the heart of it. The first rule of compounding is to never interrupt it unnecessarily. That one sentence contains an entire investment philosophy, and most people walk right past it. Here's what this video is going to show you. Two investors, same income, same starting amount. 30 years later, one ends up with around $41,000. The other ends up with $600,000. The difference between them wasn't luck, timing, or a single brilliant decision. It was a simple four-part framework called the 7-5-3-1 rule. And every part of that gap is explainable. My name is Alex. If you've ever stared at a portfolio balance that should be growing and felt genuinely unsure whether to keep going, stay with this, because the slow start isn't a malfunction. It's a feature of how compounding actually works. And once you understand the shape of the curve you're on, the entire game changes. But first, you need to understand something about the shape of the number 7 and why it's the most important commitment you'll make. Here's something that almost nobody warns you about before you start investing. The math works. It genuinely works. But for a long time, it won't feel like it does. And that gap between what the math promises and what your account balance actually shows is exactly where most people quietly give up. So before we get into the framework, you need to understand why the early years feel so discouraging. Not because something is wrong, but because of how exponential growth actually behaves. Your brain expects progress to look like a straight line. You put in money, you wait, you get a proportional reward. That's how most things in life work. You work 40 hours, you get paid for 40 hours. If you practice a skill for 6 months, you're noticeably better after 6 months. Compounding doesn't work that way. Compounding is a curve, and the defining feature of a curve is that it starts nearly flat and then bends sharply. The early years aren't slow because your investments are underperforming. They're slow because that's where the curve lives before the bend. Here's the actual math on this. Take a single $10,000 investment growing at 7% annually, roughly the historical inflation-adjusted return of the S&P 500. In the first decade, that investment generates about 3.6% of its total 40-year gains. Just 3.6%. In the final 10 years, years 31 through 40, it generates 62% of everything. You earn more in that last decade than in the first 30 years combined. Read that again. 30 years of patience, then 62% of the payoff arrives in the final 10. That's not a flaw in the system. That is the system. There's actually a name for why this feels so wrong to us. Psychologists call it exponential growth bias. It's a deeply human tendency to underestimate how fast something can grow once it passes a certain threshold. We've been tested on this repeatedly, and we consistently get it wrong. You've probably heard the lily pad riddle. A single lily pad doubles every day. The lake is completely covered on day 48. What day is it half covered? Most people guess somewhere around day 24. The answer is day 47. The lake goes from half covered to completely covered in a single day. For the first 46 days, almost nothing visible is happening. Your investment account is that lily pad in the early years. Warren Buffett has described investing as rolling a snowball down a hill. The quality of your investments is the wetness of the snow, but the length of the hill, that's time. And here's the thing about snowballs. They don't look impressive at the top of the hill. They look small and slow and almost pointless. The size comes from the distance traveled, not from how hard you pushed at the start. Most people give up somewhere in the middle of the hill, not because the snowball stopped growing, because it didn't look like it was growing fast enough. And this is the core problem the 7-year minimum is designed to solve. 7 years isn't arbitrary. It's not a round number someone picked for a slide deck. It's the point in the data where the noise clears and the signal becomes undeniable. Any 7-year rolling period in S&P 500 history has delivered a positive return more than 95% of the time. You stop operating on hope and start operating on evidence you've personally lived through. But surviving 7 years isn't just a matter of patience. Patience alone isn't enough. You need a portfolio that's actually built to hold together when the market tries to shake you out. And that's exactly what the 5 pillars are for. Most people think diversification is about chasing returns in multiple places at once. It isn't. Diversification, done right, is about making sure nothing takes you out of the game before compounding gets a chance to work. That's the whole point, not maximizing gains, minimizing the chance that you panic, blow up your portfolio, or make one catastrophic decision that sets you back 5 years. And this is where the 7-5-3-1 rule stops being just a waiting game and becomes something more active. Most investors treat compounding like a passive process. You set it up, you walk away, and time does the work. And in theory, that's true. But in practice, that's not how it plays out. Because between now and year 30, the market is going to drop, probably more than once. It's going to drop in a way that feels serious, maybe catastrophic. When that happens, the biggest threat to your financial future isn't the market. It's the decision you make in response to it. The 5 pillars exist to reduce the emotional pressure of that moment. A well-built portfolio doesn't just grow. It stays intact when things get uncomfortable. So here's how it's structured. The foundation is broad market index funds. Think total market funds, or S&P 500 index funds, that give you exposure to hundreds of companies in a single position. As of early 2026, the US stock market has delivered an average annualized return of roughly 10% over the past century, closer to 7% after inflation. Index funds capture that return without requiring you to pick winners. They are boring by design. That's what makes them effective. The second pillar is dividend-paying stocks. And these are companies with a long track record of paying shareholders a portion of their profits on a regular basis. The value here isn't just the income. It's psychological. When your account balance is flat or slightly down, dividend payments keep arriving. That's a small but real reminder that the portfolio is still working, even when the numbers don't look exciting. Third is small and mid-cap exposure. These are companies that are past the startup phase but haven't yet reached the scale of a large-cap giant. Historically, small and mid-cap stocks have outperformed large caps over long-time horizons, though with more short-term volatility. You're accepting a bumpier ride in exchange for higher long-term growth potential. Fourth is international exposure. The US market is large, but it's not the entire global economy. And international index funds give you access to growth in Europe, Asia, and emerging markets that may be in different phases of their economic cycles. When US markets underperform, international holdings can partially offset that. You're not betting against America. You're just not betting that one market will outperform every other market on Earth for the next 30 years. The fifth pillar is defensive assets. Bonds, treasury securities, or simply a cash reserve. These don't generate exciting returns. That's not their job. Their job is to act as a buffer. When equity markets fall hard, defensive assets tend to hold value or lose less. And more importantly, they give you something to rebalance into, which means you're buying equities when they're cheap rather than selling them when they're falling. Together, and these 5 pillars don't guarantee you'll get rich. What they do is make it very hard for one bad year, one bad sector, or one emotional reaction to permanently derail a 30-year plan. But a resilient portfolio can still be destroyed by one thing the pillars can't protect against: you. And that's exactly what the 3 emotional traps are designed to address. Nobody talks about the emotional calendar of investing. And there is one. It's surprisingly predictable. The feelings don't arrive randomly. They show up in a specific sequence, at specific points in the timeline, and they feel completely justified every single time. That's what makes them dangerous. Here's the thing about emotional mistakes in investing. They don't feel like emotional mistakes when you're making them. They feel like rational responses to real information. The market actually dropped. Your balance actually went down. Your friend actually did make money on something you passed on. The feelings are real. The problem is the conclusion you draw from them. So let's name them, because once you can see them coming, they lose most of their power. The first trap is doubt. It shows up somewhere in years 1 through 3. You've been contributing consistently. You've built a diversified portfolio. You're doing everything right, and your account looks almost exactly like it did when you started. Maybe it's up a little. Maybe it's flat. Either way, it doesn't feel like the life-changing wealth machine you were promised. Meanwhile, someone you know, a colleague, a friend from college, someone in an online forum, just made 30% in 8 months on a single stock, or a sector fund, or something you'd never heard of 6 months ago. And the voice in your head starts asking a quiet but persistent question. What exactly am I doing here? That's doubt. It's not stupidity. It's a completely understandable response to slow early progress, combined with visible stories of faster gains elsewhere. The problem is that the stories you're hearing are survivorship bias in action. You're hearing about the wins. The losses are quiet. The second trap is frustration. This one tends to land between years 3 and 5. By now, you've put in real money, tens of thousands of dollars in many cases. You've been patient. You've stayed the course. And the growth still feels underwhelming relative to the effort and discipline it has taken to get here. Think about a teacher named David, 41 years old, contributing $400 a month since his mid-30s. 5 years in, his balance sits around $30,000. He's contributed roughly $24,000 of that himself. The gains are real, but they don't feel real yet. They don't feel like enough to justify another 25 years of the same behavior. Frustration at this stage is almost universal. It's also almost always wrong. The third trap is panic. This one doesn't arrive on a schedule. It arrives when the market drops hard and fast. In 2022, the S&P 500 fell roughly 19% over the course of the year. In early 2020, it dropped 34% in about 5 weeks. These aren't ancient history. They're recent, and they felt serious while they were happening. When your balance drops by 20 or 30%, something shifts in your brain. It stops being an abstract portfolio and starts feeling like actual money you're actually losing in real time. The instinct to sell, to move to cash, to just stop the bleeding is almost overwhelming. And it's almost always exactly the wrong move. Here's what the data shows consistently. Investors who sold during the 2020 crash and waited for stability before re-entering the market missed a 50% recovery that happened within 12 months. The cost of panic isn't just the loss, it's missing the rebound. Knowing these three traps exist doesn't make you immune to them, but it changes what you tell yourself when they arrive. Instead of feeling wrong, you think this is the frustration phase. I knew this was coming. That reframe is worth more than most people realize. And once you've survived these traps, once you're still in the game and your portfolio is still intact, there's one more lever available to you. A small, almost invisible adjustment that nearly doubles your outcome. That's what the one annual action is all about. There is one move in long-term investing that is almost embarrassingly simple, consistently overlooked, and mathematically devastating when you skip it. It's not a new asset class. It's not a rebalancing strategy. It's not a tax optimization technique. It's a single annual adjustment that takes about 4 minutes to set up and then runs on autopilot for the rest of your investing life. And the gap between doing it and not doing it is, in many cases, the difference between a comfortable retirement and a genuinely free one. Here's the setup. Most people who invest consistently make one quiet mistake. They pick a contribution amount early on, let's say $300 a month, and they keep it there. Not because they thought carefully about it and decided 300 was the right number forever. And just because they set it up once and never revisited it, the number becomes invisible, automatic, permanent by default. The problem is that your income doesn't stay flat. Over a 30-year career, most professionals see their earnings grow meaningfully, and yet the contribution amount, the one lever they actually control, stays exactly where it was in year 1. That's the gap the one annual action closes. The rule is simple. Once a year, increase your monthly contribution by 5%, not $500, 5% of whatever you're currently contributing. If you're putting in $300 a month, a 5% increase is $15. $15? That's roughly the cost of 2 work lunches. Now watch what happens to the math. $300 a month for 30 years at a 7% annual return gives you approximately $408,000. That's a strong outcome. That's real money. You contributed $108,000 of your own. The rest, $300,000, is compounding at work. But now apply the 5% annual increase, starting at $300 a month, growing that contribution by 5% every year, same 7% return, same 30 years. Your final balance lands at approximately $787,000, nearly double, almost $400,000 more, from an adjustment that started at $15 a month. Think about what that number actually represents. At a conservative 4% withdrawal rate in retirement, the difference between $408,000 and $787,000 is about $15,000 a year in additional income, every year, for the rest of your life, from $15 a month in year 1. That is the compounding of contributions stacked on top of the compounding of returns. Two curves are multiplying against each other instead of one. And here's why almost nobody does this. It's not because they don't have the $15. It's because the reward is invisible at first. You increase your contribution in year one and nothing changes. Your balance doesn't jump. There's no notification, no confirmation that you did something meaningful. The payoff is 30 years away and spread across thousands of small compounding events that are completely invisible in the short term. But that invisibility is exactly what makes it powerful. The people who benefit most from this move are the ones who set it up, forget about it, and let it run quietly in the background while they focus on everything else in their lives. Consider a nurse named Claire, 34 years old, contributing $350 a month into a broad index fund. She sets up a 5% automatic annual increase and genuinely doesn't think about it again. By 65, her balance sits north of $900,000. Her colleague at the same hospital, same salary, same starting contribution, never touched the increase setting. He retires with just under $470,000. Same job, same starting point, $430,000 apart. That's the one annual action. Small, invisible, and compounding silently in the background for decades. Now let's see exactly what this looks like when you put all four numbers together and follow two real investors from the same starting line to two completely different finishing points. That's the real case study. Same starting line, same income, same market, completely different finish. This is the part where the framework stops being theoretical and becomes something you can actually see, because abstract principles are easy to agree with and easy to forget. But when you watch two specific people make specific decisions at specific moments, and then follow the math all the way to retirement, something clicks differently. So let's do that. Meet Jordan and Rachel, both 35 years old. Jordan works as a project manager at a mid-sized logistics company. Rachel is a software tester at a healthcare firm. Same city, similar salaries, both earning around $78,000 a year. Both start investing $350 a month into a diversified portfolio in January 2026. Same 5 pillars. Same 7% average annual return assumption. Identical starting conditions in every way that matters. The first fork in the road arrives 9 years in. It's 2035. The market has just dropped 17% over 6 months. It's not a crash in the historic sense, but it's sharp enough to feel serious. Jordan's balance, which had been climbing steadily, is now sitting about $22,000 below its peak. He remembers the 3 emotional traps. He remembers that this moment, the drop, the discomfort, the urge to do something, was always part of the plan. He stays invested. He doesn't move a dollar. Rachel pulls out. Not permanently, she tells herself, just until things stabilize. She moves her portfolio to cash for 11 months, waiting for the market to feel safe again before she re-enters. And that 11-month pause costs her more than she realizes in the moment. She misses a 14% recovery. She re-enters later at higher prices with a smaller base. The compounding curve that had been quietly building for 9 years gets interrupted at exactly the wrong time. The math doesn't recover cleanly from that. It just quietly recalculates downward and keeps going. The second fork arrives at age 45. Jordan logs into his brokerage account, the way he does every January, and bumps his monthly contribution up by 5%. It takes him 3 minutes. His contribution moves from $430, where it had drifted after previous annual increases, to $452, $22 more per month. He doesn't think about it again. Rachel's contribution has stayed at $350 a month since 2026, not because she couldn't afford more. Life just got busy. There was a car, a home repair, and a vacation that felt justified. The increase never happened. Now follow both of them to age 65. Jordan retires with just over $1,040,000. He contributed a total of around $190,000 of his own money over 30 years. The remaining $850,000 is the result of time, compounding, and 2 quiet decisions made at critical moments. Rachel retires with $412,000. She contributed roughly $126,000 of her own money, less than Jordan, because of the 11-month pause and the flat contribution rate. Her balance is real. It's meaningful, but it is not the same life. The difference between them is not intelligence. It's not income. It's not even discipline in the dramatic sense. It's 2 decisions, one made during a market drop in 2035, one made during a routine January login in 2045. Neither decision felt monumental at the time. Both of them were $628,000. That's the gap, built not from genius, but from a simple rule-based system followed without interruption. Which brings us to the last piece, the 4-step playbook that makes all of this actionable from today. The most dangerous thing about a good framework is thinking that understanding it is the same as using it. It isn't. Jordan and Rachel both had access to the same information. The difference wasn't knowledge. It was execution. And execution in long-term investing comes down to whether you've translated an idea into a specific, repeatable action before the moment arrives when you need it most. So here is the entire 7-5-3-1 rule reduced to 4 steps. Not principles, not concepts, steps, things you can do this week, some of them today, that set the system in motion and keep it running without requiring you to make good decisions under pressure. Step 1. Commit to the 7-year minimum in writing. Not mentally, in writing. There is real behavioral research behind this distinction. Then people who write down a commitment are significantly more likely to follow through than people who simply agree with an idea in their heads. Open a notes app, a document, a piece of paper. It doesn't matter. Write down your start date, your monthly contribution amount, and the words, "I will not evaluate whether this is working until 7 years from today." That document becomes your circuit breaker. When doubt arrives in year 2 or frustration in year 4, you're not making a decision from scratch. You're just checking whether the 7 years are up. They won't be. You stay in. Step 2. Build across the 5 pillars before the end of this month. You don't need to do this perfectly. A total market index fund and a small international allocation already cover the majority of what the 5 pillars are designed to do. And if you're starting from zero, a 3-fund portfolio, broad US market, international, and a small bond allocation gets you most of the way there. The goal isn't a perfectly engineered portfolio. The goal is a portfolio diversified enough that no single event forces you out of the market entirely. Step 3. Write down your response to each of the 3 emotional traps before they arrive. This sounds almost too simple to be worth doing. It isn't. Take 10 minutes and finish these 3 sentences. When I feel doubt about my investments, I will. When I feel frustrated that my balance isn't growing fast enough, I will. When the market drops significantly and my instinct is to sell, I will. The answers don't need to be complicated. Most people write something like, "I will reread my 7-year commitment," and "I will look at the long-term S&P 500 return chart." "I will not log into my brokerage account for 30 days. Simple, specific, pre-decided. That's the whole point. You're not trying to feel calm in the moment. You're trying to remove the decision entirely. Step 4. Automate a 5% annual contribution increase starting today. Log into your brokerage account. Find the automatic contribution settings. Set a recurring 5% increase every January. If your platform doesn't support automatic increases, set a calendar reminder for the first week of every January that says, "Increase contribution by 5%. That's it. 4 minutes of setup for a potential $300,000 to $400,000 in additional retirement wealth over 30 years. These 4 steps are genuinely not impressive to look at. They don't feel like the kind of thing that builds a $1 million portfolio. That's exactly why they work. Impressive-looking strategies invite constant tinkering. Simple systems get left alone. And the single most valuable thing you can do for a compounding portfolio is leave it alone. Charlie Munger said it plainly. The first rule of compounding is to never interrupt it unnecessarily. The people who win this game aren't the ones who found a smarter strategy. They're the ones who built a boring system, wrote it down, automated what they could, and then got out of their own way. The map has always been simple. The question is whether you'll follow it long enough for the destination to appear. Here's what this all comes down to. The reason compounding feels broken in the early years isn't because it isn't working. It's because you're in the part of the curve that was always designed to feel invisible. The math is running. You just can't see it yet. A few things worth holding on to. The slow start isn't a warning sign. It's confirmation that the curve is building. Diversification isn't about maximizing returns. It's about staying in the game long enough for the returns to arrive. Emotional traps don't signal that something is wrong. They signal that you're exactly on schedule. And the 5% annual increase isn't a small detail. It's quietly the most powerful decision in the entire system. Next time you feel the urge to check whether your portfolio is working, ask yourself a different question instead. Am I still in? and because staying in is the strategy. There's a related question worth sitting with. If compounding rewards patience this dramatically, why does the entire financial industry seem designed to keep you constantly doing something? That tension is worth exploring. If this changed how you see the waiting game, share it with someone who needs to hear it.